Sup, YouTube? It's Joe Paulia sitting on the couch, making some money, investing in fractional real estate online, as usual. Today, I am going to do something a little bit different, though. I don't think I've ever done this. I'm going to try to cover two properties. If anybody's been paying attention, M1 or Josh, he's been in the Discord quite a bit. He's taken over several of the properties that were managed by Yom, but he's also bringing several of his own properties to the platform. And today, two of those went live, or really yesterday now because it just turned after midnight. But they're both in the same town, so the market's going to be the same. They're both single family homes. So I'm gonna talk, but they are quite a bit different in the financials and whatnot. But I think one, it'll be interesting to maybe compare the two. So anyway, the first, and I wanted to talk about this co-owner in general though too, because he seems to be quite an accomplished real estate investor. He posted this not too long ago in the Discord that his book, it's an ebook, Swing or Be Swung. I read it the other night, and I agree with him on almost everything that he says in here. Like I think that with the way that we think about real estate is very similar. He's not a buy and hold forever guy. He is, he's the too long didn't read of this is buy as cheaply as possible. You make your money when you buy. Hold it for at least a year. Getting that long term capital gains rate. Not don't do like a flip. Do like rehab that actually makes it a good rental property. When you sell it as a business. That's all of those things I think make a ton of sense. I think that especially in the market he's in, where you have pretty strong rent to price ratios, a lot of people like to buy a turnkey rental in a market like his. So I think a lot of what he talks about makes sense. Um, you know, and he does talk a little bit about parking money in fractional real estate, but it's clearly not how he's made his money. It's he's and he he's explains that it's you're not making the same kind of returns when you're parking money on there. Um, but so anyway, I believe that he's from Tiffin or he lives there now. I had never heard of this town. I had to look it up. The closest big city, the closest city I've heard of is Toledo, but it's outside of Cleveland and Akron. So the first thing I did went to why is that the one that pops up? I went to Wikipedia, looked at the population data. It's not, doesn't look good, right? Like me, I like a metro with 100,000 people plus. I want to have a growing population. So this wasn't it for me. This is uh, typically not a great sign for a long-term hold. Now, I completely understand that this is a market that you can execute his business strategy all day, every day, uh, and not really have to worry about, well, what's the future of the market, right? Like as long as 1 year or 18 months from when I bought this property, there's still rental demand, there's still demand for in the market. But I do wonder about when I'm looking at properties that I want to invest in for the long run, which is any of the ones that I'm going to pay close to par value on. I need to really like the market long term. So for me, this was this would be a no go unless there's quite a bit else to like about the property. I wanted to look at though. Let's look at the county too because 17,000. I mean, almost 18,000 population. It's just so small. And I'll show you an example of why that becomes a problem too. And so I looked at the county data. The county data is actually even worse in the recent years as far as shrinking. It's also still pretty small. There is there was an additional like what do they call it? Micropolitan statistical area, but it didn't really have any good data in it. And this combined one, yeah, it wasn't too useful either. So none of that made me feel great about the market as far as for a long term hold. Um, and I'm gonna kind of blast through some of this stuff real quick because there's some details I want to get into, about each property, and I don't want to talk about these for 2 hours today. So one of the things though that I thought was really interesting, this is the lowest risk index score. So I'm looking at the FEMA National Risk Index. That's usually the next thing I'm going to look at. This is the lowest score that I had seen, um, which is good, right? Low is good when you're looking at the risk score. Um, You know what I didn't even do? I didn't even look at the spot crime map. It's just I had so many tabs open. I wanted to get this going before my computer died. Let's do that real quick. Let's look at the spot crime map for each. So this is the first one, right? 51 St. Clair Street. I don't know why I couldn't. I was trying to say 51 Street, but obviously that's not it, right? So let's see. Let's look at the spot crime map because that's what we usually like to do next. Hopefully I don't crash this. It is, I have way too many tabs and it's probably time to get like an even better laptop. I have a pretty good one, but I'm just, yeah, I don't even have to put the other address in, right? I mean, it's just, we've never seen a map like this, right? So, but it makes sense because it's a very, it's very, the population density just really isn't there. Um, so, those are two things really going for the market. Low risk index as far as natural disasters, and then yeah, I mean the crime looks very very low, but again, it's relative to the population. Um, just looking at the Zillow home values, they had a little bit of a dip just like everybody else, but this is a pretty steady climb. One of the things, this is the whole, Tiffin housing market, and it's only 44 homes for sale. Yeah, it's a good trend, right? Like, so if it was just this most recent one, I'd be worried. But whenever you have a really small sample size, it doesn't take a whole lot to move it one way or the other, right? And so whenever I've always been a little bit skeptical of the median home prices because it's median uh, can be affected a lot by what size homes are selling and whatnot. And I think that's even more so true when you have such a small market like this one. But let me get rid of that. Um, I did look at the flood map for each of them. For this is let's see. So I didn't even tell you the two properties. So one is this 51 St. Clair Street. The other one is 395 Main Street, both in Tiffin. Sorry, I don't know. Sorry about that. But so this is the Main Street property. It is, this is the FEMA flood map. Looked good to me. The other one did not. And so for me, for the most part, flood zone is a no-go. I have made a couple of exceptions to that rule now on Lofty, but only in very small amounts. Um, and so that's the other thing, and I think that might be the reason why. So if you look at this property, uh, the rental yield's 5%, and you look at the Main Street property and it's 19.6%. Okay, it's the same guy that owns both. Like, what's going on here? You might think to yourself, but there's leverage on one. The Main Street property has a loan on it. Um, the St. Clair property does not. And so one of the things I think there's a good chance that it doesn't have it on it because, well, I don't know. I don't know this. I actually didn't. It's tough. It's often when you're going to finance a property in a flood zone. I should have looked at that. I'm going to look at that now. Look at all these things that we're digging into together in real time. Um, I know they always give us the insurance. Does he have flood insurance on this? Are we gonna have? Is this searchable? It's not. But I think we're just only gonna get this anyway. Oh, okay. Let's see. What are we doing here? Coverages. I don't even know. I'm not going to waste your time on me going through this. That'd be something if I were going to buy into this one, which I'm not. And that's the other thing too. I'm not super knowledgeable about flood coverage because I haven't bought I haven't bought properties in real life in flood zones uh in forever because if you deal with a flood one time and deal with the insurance company, at least for me, it's something I never want to do again. And so that's it's something that I just typically avoid. But so sometimes, if you're going to get a loan on the property, they're going to make you get flood insurance coverage. And sometimes that flood insurance is just so expensive, a lot of people in those markets just decide, I'm not going to get a mortgage. I know there's a lot of parts in Florida where this is the case. My dad is one of these people. He bought a home in Florida. He was trying to get a loan. They told him he had to get flood insurance. It was like $12,000 a year, and he was like, "Okay, forget it. I'll just pay cash for the property." Actually, he got a HELOC on a different property and did it. But so that's That's what I think is, could be the reason. There could be another reason. It might be that this one was just cheaper. Um, but so this one to me seems like a really hard sell, right? You have a 5% rental yield. It's because it's an unlevered property. Um, it is in a flood zone. When I went through, okay, Zillow thinks it's worth, let's see, where is their estimate? Significantly less. Oh, well, this is one thing that he did though that I really respect. I think this is nice. This property is it appraised for 135,000, 135, and he's bringing this to market at 135,000. This is something we very rarely see on Lofty lately, right? Everybody's bumping it up an extra 5%. He did that on his Main Street property, right? This one appraised for 179, and he bumped it up to 5% that he's allowed. Nothing wrong with that. I think he understands that this is just a more attractive property. It's got a better yield. The property itself looks better. It's not in a flood zone. So like I get it. Like, maybe he sees that people are going to see more value in one than the other. I mean this is my guess, right? Like I didn't talk to him about this. I don't know what he really knows. Um but yeah, so I don't know. This one to me is a really hard sell, right? Like it's not a great yield. I mean, it's unlevered, so it's not terrible for a completely unlevered yield. But it is in a flood zone. And oh, the what I was trying to open was the inspection next. Oh, but let me tell you a little bit about the appraisal. It did appraise for 135, but there's a note in the appraisal that there were, very few sales in the area. He had to go, so he had to go further than 90 days back. Um, limited, and so this is one of the reasons that I like larger markets is because, when you have a bigger and denser market, you typically have more sales, and it's a little bit easier for appraisers to do their job. Like, so we looked at that Zillow thing and it says 107 and this says 130, the appraiser says 135. It's just because it's really hard, the data, um, when I worked in appraisal, I worked on some of these like really small markets, and it is just like, you can almost come up with any price you want depending on, do I want to go further back in time or do I want to go further out in distance, or am I going to make a little bit more adjustments to the property itself? And so, I think that to a certain extent, it's just really hard to value properties, consistently in a market like that, right? And so it becomes much more of that property's worth what somebody will pay because it's just a thinner market overall. But that's I just wanted to share that about that appraisal. I'm just gonna close these as the Main Street one appraised fine. They actually didn't have that same note, but they had a similar note where they had to, they only had four sales and whatnot. And this is one, it was interesting. It only appraised, he bought this one at 150 and it appraised for 179. He bought the other one for I think 90 and it appraised for 135. So his, the margin on this one was much smaller. Um, which is probably why he wanted to do that extra 5% as well. Uh, but let's see, else I wanted to say about this one. Oh, and so then going through the home inspections, this is a property that he's owned for a year and a half or 2 years. Um, there's a tenant in it, so it's at least somewhat operable, or you'd expect it to be. But there were like a lot of things that, like, okay, you've got gutters that haven't been cleaned. There's a lot of little things. You've broken glass on a window. Um, this stuff. So one of the things I started to think about because I did read his book, the Swing or Be Swung. He's typically made his money with very or relatively short term holds, and in exiting properties, right? And so. Um, I think that when you buy a property and you do a renovation and you get it ready, like if you are planning to hold that property forever, you're in a different mindset than if you're thinking, I'm going to sell this to somebody in a year and a half. I think that the things that you maintain and the way you maintain them might be a little bit different. And that's sort of what I thought here. Like, I would never have. So one of the things people think like gutters and downspouts and stuff like that aren't that important if you haven't been around a lot of real estate, but um, getting water away from your foundation is one of the easiest ways to prevent, foundation issues in the long run. Like a lot of the issues that happen with foundations happen because you end up with water close to your home. And so like stuff like this, like it's really simple. It's a low cost thing. So it's surprising that this is the solution and not something further, right? Like just little things like that. And you have some settling in the steps. A lot of times you'll get settling in these things more than you will on the property itself. So, I mean, definitely not like some indication that there's something wrong, but it is, and it's another one of those things that maybe if I were going to hold this forever, I would have addressed. Where if I'm thinking about selling it, it's a small thing and it's not going to change the price, right? Oh, and then he's got the, a little bit of negative slope here. Again, like on a property that I buy that I plan to hold long term, if I see this in an appraisal, I mean in an inspection, I'm always going to address this. I never want to have water pooling by the side of my house. And so that's what that it got me wondering, like, when he, first did the renovations on these properties, is that, was it a shorter term mindset, and therefore, some of the things just weren't addressed that I think a long-term holder would. I mean, I don't know. Um, it's tough to know, because there's different standards, and also I don't know that market, right? Maybe they're in a place where, you have a more robust, soil, so that you're not like I know in San Antonio, if you let the water pool by your home, in a couple of years, you'll end up having to level your home again, because we have what they call expansive soil here. I don't think that it's anywhere near that level there, but it's still something that everywhere I've ever owned a property, I've never wanted to, leave it like this to where you'd have that negative slope and have water pooling by your home. And then there were just like a couple other little things that like I just would have thought. I was just surprised. He comes across as a really knowledgeable professional talking to him, just through the Discord, and hearing him talk on he was on that call with Cal, I think, is when I'm not even sure. There was one of the ones, though, I heard him talk. I've never talked to him directly. Um, and because we do think so similarly, like when I read through his book, like so much of it rings true to me. I just thought that we would have a similar approach to, the level of maintenance at a property. Like this was one that really bugged me, right? I mean, it's such a minor thing. It's like in your panels, like when you have empty spots, you just fill them. You put caps on them. Now, it's possible the tenants remove those for some reason. I think it's very unlikely. Like just little things like that. Just because one, it's to prevent moisture and bugs from getting in there. Not that it keeps them out completely, but it can. It helps, and then it also just like keeps it from your tenant going down there messing with the breakers and sticking their hand in there for some reason that they shouldn't. That's one of the things whenever you do have tenants, you try to kind of idiot proof the house as much as possible, right? And so, so just a couple little things like that. I mean, there was nothing major that I was like, oh, that's a huge problem. This other thing too, anytime I've removed a chimney, um, I wanted to get rid of the whole thing, right? To leave this in there is it's just like, again, I mean, I get it. If you're not holding the property forever, when you're buying and selling, you're not going to get a return on taking this out of there. But if I'm going to keep this property for the long run, at some point I want to deal with it, and so it would be now, right? And so that's it's just a little bit different of a mindset, I think, and I think it leads to doing some things that I would just do differently. And then, but yeah, it definitely eats into your profit if you do that, right? So I don't know. I just wanted to point that out, but like I said, or like I always say, just because I would or wouldn't buy this doesn't mean you should or shouldn't, right? You want to look through all this stuff and decide on your own. Which reminds me, please like and subscribe. And in the description to this video, there's a link to the Discord. You can join that if you want, the fractional real estate investors Discord. If you want to talk to, there's quite a few people in there on a daily basis. Feel free to jump in there. Share your thoughts on this. Definitely, if you have different thoughts, I know some of you guys that are going to watch this, and some that are in the Discord regularly, are big fans of M1. This really hasn't changed. I'm not saying that I'm not. But I'm just going to give you as honest of a review as I can on all these, just like I do for all the other people that I interact with and like on there. Um, but yeah, you can join that Discord, and also there's links to all the places that I invest online in fractional real estate. Do your own due diligence on those sites. Just because I invest on there doesn't mean that you should. And the same thing with these properties, right? Just because I say I don't understand why anybody would buy this one, doesn't mean that you shouldn't do it, right? Like, I mean, maybe. So I actually have a couple ideas. There are some people that don't like to have debt on properties at all, or because of their religion can't. And so maybe this is a good solution for them. I still have the issue with the size of the market, and I have the issue with the flood zone. I'm not even going to really dig into the financials too much because it is, it's just a very low yield. So for me, if I'm thinking risk adjusted return, it's just hard for me to get on board with that one. So I'm gonna stop talking about that one. I'm gonna close it out. Um, it's interesting too to bring them both to the platform at the same time, and he's got a couple others that I think he meant to have up this week, and maybe Lofty dragged their feet on, or maybe they waited for the appraisal too long. I'm not sure what happened, but I think that he's gonna have two or three more. But it's like if you have this one at the same time you have the other, and I'm okay. A big part of why I'm investing at this point is I'm making a bet on the co-owner, right? I think somebody's doing a good job bringing the property to the platform, uh, doing a good job managing. Okay, so if I want to buy from him and then I have two completely different options, maybe it is. Maybe it's a matter of he knows some people just want the unlevered one. Um, I'm really not sure. I thought that was kind of interesting to see that. Or, the other thing too, because it sounds like he manages a big fund. Oh, I wanted to point that out. So, when they're describing him, I think, yeah, he oversees a $10 million worth of real estate portfolio which is over $10 million worth of real estate. Um, they mention, is it in this one that they mention it? Yeah, that he's consistently generated 60% plus average annual returns for himself and his investment fund. And I completely believe it with his what he calls swing trading strategy. I think that it's very possible to do that. The shorter term your holds, and we talk about this all the time on here, right? Where I'm flipping tokens really quick. The shorter term your holds, the quicker that you can, reap the rewards of having purchased it really low, which is a big part of his strategy, and also any value add that you do. But I want to point out that this is not you, right? Like if you're buying this property, you're basically the exit liquidity for for this strategy, right? Like he's already bought it. He already bought it cheap. He, did the value add, and now this is the exit, right? This is his exit. Maybe not completely, maybe he's still holding part of it, and well, I mean, obviously he's going to hold some of it, but this is, you're not involved in this 60% type of annual return. Now, maybe this is a opportunity to form a relationship with him as an investor in these deals and jump into that. I don't know. I mean, I have no idea if that's a possibility or not, but I just wanted to make sure, if you also saw his book and read it, and then you see this and see, oh, he's consistently made these really high returns, you don't think that somehow that's going to translate into you making those really high returns on these deals, right? And now this one, it's getting very close to the 20% yield that you see a lot of properties get brought to the market on. So I think it's perfectly reasonable there. Um, let's see, what was I going to, there's a couple of things I wanted to talk about this one. It's got a decent rent to price ratio, right? $1,500 a month for the 179 appraisal. What is that? I didn't even plug that in. Yeah, it's a point, almost 0.84. Um, that's a little bit better than what you can find on a new construction home here in town in San Antonio. It's not way better though. It's only a little bit better, right? So that's kind of interesting to see. And then, but if you do it on the, let's see, do it on the 187.9, so 1,500 divided by 187.950. Yeah, point 0.7. Yeah, and then now that gets really close to like what we pay on new construction. But the big difference here is his property taxes are going to be so much cheaper, I'm sure. Yeah, for the same, we probably pay almost double that in taxes for the same, relative value home here. Is that true? Let me do the math on that. Oh, we're doing lots of math today. Hope everybody's having fun. I love it. So yeah, we pay about double that for real estate taxes. So so we need a little bit better rent to price ratio to be happy. But if I'm going to compare this to a deal I can buy here, I can buy a brand new home here. Uh, rent it for 1,500, pay somewhere around that, right? 190, 200,000. Probably a little bit like right around 200,000, but get a really good interest rate on, because you're getting a builder interest rate. When I make that comparison, it's hard to do. But then, okay, we go back and see this yield. Well, yeah, this has the fantastic yield because it comes from, what Lofty's always doing, where the co-owner is paying the mortgage, right? And so, and he's footing that bill, and also, let's see, he doesn't have a huge management fee. He's got a 10% management fee on this one. Is that true? I looked in the other one. Let's see. Main Street. Yeah, I don't know that I'll ever try to do two of these at the same time again, but I just wanted to really, compare the two. In the first one, I think for me was really easy to just say, I don't. Yeah, okay. So this one too, he's got the 10% management fee. It's just really easy to say that I wasn't interested in that other one. Um, and I just wanted to point that out. Oh, let me see if there's one more thing. Yeah, again, Zillow thinks this one's worth, more than what he's bringing it to the market to. Again, I think this is just a matter of, um, it's a thin market, right? It's a small community, and it's there's just not as enough trades, just like the uh, appraiser said. So he was a little bit lower than Zillow on this one. He was significantly higher than them on the other one. But I think it's more a data issue than anything else. Like it's not that it's just tough. It's tough to sometimes, like I said, when there's just not a lot of data, not a lot of sales, it's tough to be sure. I mean, when the whole market has 44 homes for sale, um, and then you need to find one that's close to what yours is, it gets difficult, right? Um, but so a couple other things about this one. So let's see. When you've got the financials, like I said, you have the decent yield. Again, this is always true on Lofty. It's because you get it brought on here when there was no vacancy and uh, no capital improvements or no repairs and maintenance in the last month. So none of that gets annualized and put into there. Obviously, if you're going to think about what's your actual return going to be going forward, it's not going to be this number because there's going to be some months where you are just going to have, a turnover or, which is going to have repairs and it's going to have vacancy. And so I wish they would put some sort of allowance for that, but they don't. Oh, I know what else I wanted to say about this, and this is a silly one, but it is. You guys have heard this from me a lot of times. I like his folders. I think he's set up his folders well. As silly as that sounds, um, it's been and I don't know, maybe they're actually, maybe Lofty's doing this now, but I don't think so. I think that they're giving them their own Dropbox. But like some of the folders are set up like just so terribly, and here it looks like he's got some good organization. Hopefully that continues because I think it makes it better for us as investors if we have people running these properties that are organizing things well. But then I really hate the format of his cash flow statement. One, it's just like, it's I wish they I don't know, I just feel like the standard is across, not down. Like every real estate group I've ever worked with, they always do it across. But then you also get a lot more details in each line item, right? Like we've got all these expense items, but we have no idea what made, where those came from. I think it's because he's just doing, he probably has it somewhere else and he's just put together like a very simple one for us to put it on here because they require it. But hopefully he goes to a format that's similar to like what Earl or Alec is using. I mean, that's just my favorite one. It makes it. I just find it, one, you have more detail, but it's also just easier to go month by month and see like what expenses, which one's different. You can do it down. There's no reason not that you couldn't do it this way. But if you do, tracking your what that expense item is when you get further down, I think is why it really, you can just free sell. It's just me being a grumpy old person, probably. Um, so, this one, it's not in the flood zone. If you can get past the market, which there are plenty of people that invest in small markets, right? And so, I really get that um, mindset from when I worked on the institutional side. And, it is, I do think there's a lot more stability you get with a bigger market. I didn't dig into who are the large employers here, like what people are doing out here. That'd be something if I were going to buy into this, I'd want to really look at that. Um, but it's just such a small community. It's any single employer, regardless of what the industry is, has the potential to really hurt it, right? Any single somewhat large employer. Um, let's see. The only other thing that I wanted to mention about this one is looking at the loan docs, right? And that's why we get this great return is because again, Josh or M1 is paying the mortgage outside of the structure of this, of the DAO. But when I was looking at this, it's an open-ended mortgage, um, which is, this is basically like a home equity line of credit. It's a credit line against this property, and so that worries me a little bit with the way that Lofty works. This is something that I'd want to dig into a little bit if I were going to buy this, because, and you might not, that might not ring any alarm bells for you immediately, but what it means is, okay, you could pay this down and then you get granted some tokens, right? For paying down your equity, but then you can draw against it again, right? Like it is, the maximum was 124. So it looks like he's already drawn the maximum. Is that true? 123, 850. So yeah, basically the maximum. So there's not like some danger of him going and pulling out a bunch of additional money. Um, but there is the situation where he could pay down the mortgage and then use it, and get some tokens, but then use it again. And so I don't know. I'm guessing Lofty hasn't thought this through, just because of how everything else is going with some of the refinances from other. And I want to just make sure it's clear. I don't think that this is his intention. I don't think I haven't gotten that sense. I just don't. I don't know Josh at all, other than the few interactions I've had with him. It doesn't. He doesn't. This is. I would have this worry no matter who it was, right? Like this has nothing to do with him as a person or something. Um, it's something that I think us as a community should be much more aware of after all the recent Yom stuff, right? Like, if you really have to think about, okay, where are we opened up to, being taken advantage of by a co-owner or property manager? And this is just a really obvious weakness in this strategy, right? Like, because if this gets paid down, and tokens are released, and then he draws on it again, how are they going to address that? And how will they even know? Because, uh, yeah, I guess they get mortgage statements regularly. Um, but so it'll be one you want to keep a close eye on. You might want to ask that question, right? Like, how are they actually going to address it? Because I don't actually know. They did. Let's see, where do they even talk about the mortgage on here? Property details. Let's look. Nope, no financing, no loan. No, huh, okay. So did I only see that by looking at the document and looking at it? So here we can see the current loan, 123, 850. They gave us the notes, or uh, the documents here, which is the open-ended mortgage. I don't know. This one was an interesting issue for me, right? Because um I like that you're getting a much better yield because this exists. But at the same time, Um, I do. I think it opens you up to just a little bit more danger of, some shenanigans happening. And like I said, I mean, not that I am any way like accusing him of having that intention, It's just that it's an issue that I don't believe. I'd be shocked if Lofty has already thought of this and said, okay, this is what we're doing to protect from it. Um, and it is also, it is the margin added to the index, right? And so the index rate, so it is a mortgage with a floating rate. Um, again, that's rarely a problem unless something happens to where the co-owner can't pay it, and then some for some reason it ends up the responsibility of the DAO, right? And so that's one of the things that I'm just always looking for. Like, if the DAO has to take over the financing, what does that look like? And so then if we look at the financials today, I actually didn't notice what the actual payment was, but the interest rate is higher than our cap rate, so it's a negative. It has a negative effect on cash flow, right? It's not positive leverage; it's negative leverage. But other than that, it's a relatively low, 124 basically against your 179 appraised value. Um, it's a low leverage, but it is just one of the things that you always want to look at, right? Like, and then one of the things that comes up quite a bit, and it's not always easy to understand, is, well, why would he want to be paying such a high yield on this? Um, but and I think the answer is, by having to pay for that mortgage, and especially on this one, it's not that he's selling out for he's not getting a very big profit. I mean, it's not terrible, I guess. 150 to 187, 188. Yeah, I mean, it's not terrible for a short-term hold. But it's not as if it's, the well, and it's levered, so yeah, I guess actually it is a pretty good return to be able to sell out for that amount because of the leverage. Because if he bought at 150 and he's got 124, so he's going to put 25 down. So yeah, maybe it is. Maybe it's a double. Well, it's not really a double, but maybe it's close to a double on the equity. So I think that's in line with the 60. And then, so presumably he's taking that money and he's going to go do it again. And if he has consistently made 60% returns, okay, maybe it's not the worst thing in the world to have to pay a 20% yield out on the equity that he sold, right? Um, and that's kind of how I think about it. It's not exactly paying a 20% yield out, but like when you think about the co-owner's situation, when they're paying for that mortgage, that's moving your yield up from, I think this was, let's look at what it is. Um, yeah, the cap rate 6.84, which is actually a pretty decent cap rate. But if you take that, but again, this is a lofty cap rate. It's not a real cap rate. Um, there's no vacancy collection loss. There's no repairs and maintenance. Like, so none of that is in there because they're just looking at 1 month. Um, but even with all that considered, I mean, 6.84 is pretty good for a single family home in a lot of markets. And so, but to bring that up to the 19.63%, it only happens by the co-owner paying that mortgage. And so basically, they're subsidizing that return, right? Because they're not, especially when the mortgage that he's paying is, the rate he's paying, he's actually got negative leverage on there. Uh, so it always begs the question, like, well, why are they willing to do that? And some of the times, it makes a lot of sense because, they get to dilute you on the appreciation side. So if you're in a market that you think you have a lot of upside in that property, I think it makes perfect sense. Um, doesn't I mean, I don't know, I guess the price has been moving up here, but like I think the long-term prospects here, it's tough to see why prices would keep going up when you have um a shrinking population. So it doesn't seem like that's it, right? But I think it's because the his cost, it might be he's just going to get a better return on that capital elsewhere. So if he has to pay a little bit more for it here, he's just pulling it from anywhere possible. Now, why do this instead of a sale though? That's a good question, and I don't know. It's one of the things that I'm always curious about. So maybe uh, I'll have to ask him, see if I can get him on my channel at some point and actually ask him all these questions. Now that I told him I'm not investing in that other property, and this one is also not for me. Um, Hopefully that doesn't hurt his feelings. But uh, This one, I think if you get past the small market, this one makes more sense, especially if you can get a good answer to the HELOC question. Because I don't really know. I mean, I don't know. Um, it would be tough to monitor. Well, I guess if you're getting bank statements every month, it's not tough to monitor. But then I don't know what you do, right? Do you just make them give the tokens back each time it happens? I mean, I'm just not sure. Um, yeah, and like the real worry would be like, okay, that gets paid down almost all the way, right, to where there's like $5,000 left. He gets all those tokens. He sells all the tokens so that he can get the cash. Then he levers it back up, it gets all the cash again, and then runs off with both piles of cash. Now, again, I don't think that's the plan here. I'm not saying that it is. That's just the risk, right? By having that ability to redraw it, to take money out again, versus a regular mortgage where it's not set up like that. That's it. So that's not too bad. 41 minutes to go over two properties. I know I really rushed a lot of that. Hopefully some of this was helpful. We definitely saw at least that HELOC issue was a new issue. I am curious if you're planning on buying into either of these. I mean, I kind of understand why you'd buy into Main Street, right? Like if you're just somebody who likes the yield, you like Josh, you think he's going to do a good job, and and you're okay with a small market, well, then I completely understand this one. If you're going to buy into the other one, much lower yield in a flood zone, older property. I think it was older. Uh, what's the reasoning there, right? Like, is it just you don't like debt at all? Uh, that's I'm just curious, right? So feel free to put that in the comments. Put it in jump in the Discord and let me know. If we're not friends anymore because I said bad things about this, I'm sorry. But it's just tough for me to know. It's tough to know because one of the things I'm always doing is like, and I think that we should be the goal of an investor is we're making relative choices, right? Like we all have a limited amount of money, and we have to put money here or there, and so we're looking for the best risk adjusted return over time in each spot, right? And so it's really hard for me to look at that, 5% yield uh, on a in a flood zone in a market that I don't really see, I don't expect to grow long term. It's hard for me to do that when like I can compare it to, well, one, like a lot of the deals on Mogul, right, where you're getting double digit yields where you also have leverage, so you're getting levered appreciation, right? Because it's not this outside of the Dow thing. That's after paying your cash flow. You can get some, low double digit yields, but still, in markets that I believe are going to appreciate long term. Like when I compare them to those, it's really hard for me to get on board with that. Here, this Main Street one, okay, you have a little bit, you've got the higher yield, but again, I really have a problem when the property would have a hard time with the yield. Here, I don't think it really would. I think it would be for, you don't you have plenty of equity. You could have a sale if you had to, but I think there's also it's a small enough mortgage relative to the total cost. But I mean, it would, if all of a sudden tomorrow the Dow had to take over payments because for whatever reason they weren't being paid, um, your yield would drop to below that 6.9%, right? It'd be even lower because you'd have the negative effect on the 8% interest on the portion that's mortgage. So I don't know. If you're planning on buying into either of these, let me know. I'd love to have a discussion about them. I'm always happy to find out what I'm missing too, right? Because I mean, the reason I want to have this community is so, or trying to build this community up a little bit more is so that we can all make better decisions together. And so I'm sure there are times where I haven't bought into something that was a mistake, and I'd love to hear about those too. And speaking of mistakes, until next time, oh, look at that. That's like a really whatever you call that. Until next time, I'm going to keep making mistakes so that you don't have to. It could have been, and then I screwed it up by talking in the middle. Sorry about that. Transition. The word was transition I was looking for. Now it really looks dumb. Sorry. Have a good night.